The question is, when you're dealing with a customer base that is one bad day away from not being able to repay the debt, right? Or they're very prone to disruption of any kind that happens out there in the economy. Probably the first to get hit. Uh, when you're dealing with a customer like that, how do you build a profitable business on top of that? Because anything could sort of lead to a high default rate.
See, in my experience, what I have seen is in this kind of a customer, they are not as vulnerable as we think. And because they're all having an asset that is backing them, that is earning for them.
Yeah.
So whether it's a vehicle or you have machinery, whether you have a shop, something is there for them to earn. So that's one. That's the one plus point. The second is the in the worst of worst, if the breadwinner is no more or having a serious health issue, then only the customer will be in a default. So I would like to hear differentiate between delayed payment and default.
Yeah.
Because the delayed payment is something which we can expect at this particular level, because they have a cash flow mismatches in their business. Whether it's a vehicle owner or shopkeeper, one bad day or some or strike or something, you do have cash flow mismatches, or what to get as a credit and what to give as a credit. If there is a mismatch, also you have some cash flow mismatches. There is big delay. A delay doesn't mean default. See, the NPA is very strict. It compartmentalizes you. But if you look at the customer, there will be a customer who would have paid 4 months delay, but happily completing the loan. See, as long as he completes the agreement value and loan and pay the late payment interest, we are quite comfortable. It need not be, it may be in the eyes of the accounts and maybe in the regulator norm, it is NPA, but it is not NPA. So delay doesn't really bother us. The intention or something happening to the breadwinner, that really bothers us. So that is a small percentage, and that will remain a percentage as long as you manage it. If you should be able to deal with it, manage it. I think we are with since it is divided between so many people, individuals, we have no risk of having a big NPA in one particular account.
Yeah.
And therefore, I think we are very comfortable. NBFCs are generally a more comfortable situation because of the small ticket, well distributed among high number of people is what I believe.
Okay. Raul, does the volatility worry you at all?
See, there's a reason why our NIMs are equal to the lending rates of banks, right? As in, we do get in customers who have a certain element of vulnerability, which is higher, and that's the business model. But I did mention, our NPAs went up to 16%. Today they are at 4.2, 4.3. Now, one needs to, besides looking at default and delay, also look at ultimate credit cost. While NPAs might be high, the ultimate credit cost is a good reflection of really what is the vulnerability of the model.
That is just for your interest rate, the charge that you're making. Yeah.
Exactly. Yeah. So if your business model can have the appetite to subsume that, then clearly, you're on top of at least the predictability on the range of default. And, we talked about how COVID taught banks and NBFCs how to be more resilient. But I think when, we have, in the 6 lakh villages, we have a customer in 4 lakh villages of the country. When we look at what has changed since then, I think there's an element of even diversification in their incomes. Many customers who were primarily single source of income have realized on how to kind of within their households diversify their income. Whether it's a dairy income, whether it's sending somebody out to do some remit from an urban to a deep geography location. So that has happened. It's a good sign for us. We are able to build that amount of diversification in their incomes and get that kind of repayments. But even the whole UPI stack, and we don't really have to go. I mean, we used to collect 70% cash. That is today only 30%. So consumers know that if there is money in the account, they can conveniently pay it back. Earlier, to travel 10 kilometers to a branch to pay was inconvenient. So whoever turned up first, the money lender turned up first, would be paid first. So I think there have been structural shifts, one in cash flows of these customer segments, two in the ability for them to pay, and three, I think RBI has also pushed us. See, we were happy with collecting before 90 days. Now RBI says, it's not end of month, it is on due date.
On due date.
So that amount of push also brings in an element of seriousness within your organization, and all of this put together reduces the volatility. And yeah, I think it's come down. It's not that it's completely gone, but for our business model, I think we factor it in the overall ranges.
My last question is in terms of the role of NBFCs in this growth cycle. We've discussed that at length, but what are the potential challenges that you're looking out for? Because there is a growth cycle coming for sure, and it is as effective for you as it is for any bank out there. But what is the challenge that you're seeing that you probably should watch out for?
See, in India, I only two things which I really feel a challenge. One is the drought for 2 consecutive years, virtually having a challenge on rural economy, because rural consumption and population is large. Population is 65%, consumption is 45%, and that can have an impact. That's the one area which we are lucky enough in the last 5-6 years we never had. Even this year, even though it is erratic, the monsoon has been reasonably good, except for few geographies. So we have been lucky. India has been lucky in that matter. So that's the only one challenge I see from the external. The internal is basically it is the what you call regulatory interference sometimes can have challenge on the NBFCs if there are forced changes, but I don't see, because RBI has been very consistent for the last so many years. They have been guiding us consistent. Whatever they have done, 2-3 years advance, they have been telling us and moving. So I think there has been quite a good help in support from the regulators. So these two risks I don't really see happening. Therefore, I don't really see a challenge unless Indian economy or Indian GDP growth comes down below 6%. So otherwise, I don't see any challenge for NBFC.
Okay, Raul, your view on what is it that NBFC should probably watch out for if they're going to participate in this growth cycle?
So we are seeing a good kind of run so far. It's been a pretty benign risk cycle for quite some time. You'd have heard some folks making comments on unsecured lending is starting to see a little bit of heightened risk. We are also seeing El Nino and kind of commentary, because while up till July we had decent rains, August was quite a bummer. And thankfully September has kind of crawled back. We've seen some decent amount, but if monsoons, which still there is time for us to kind of call that as deficient or decent, it does impact rural sentiment. While you might say reservoirs are decent, but rural sentiment is largely guided by monsoons. So I would say the whole way in which this plays out is important to watch for. The unsecured surge over the last couple of years, the overall leverage in households, I think that's a matter of maybe we'd have to look out for that. Both of us are largely secured, so we might have less stress, but if a household is leveraged, that is stressed. And of course, we expected interest rate cycles to at least start seeing some decline, but we are not really, you've seen where kind of inflation is. We are seeing crude is at 90. People are predicting some levels of crude going up. So for us to have had maybe a little bit of relief in the third, fourth quarter in terms of names, in terms of overall ROAs, those are, I would say, the 2-3 challenges that we see right now. And of course, some long-term leverage would be what I would call as something to watch out for.